Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
So QXO Inc., it's really not just an equity ticker, is it? It feels more like a psychological case study playing out in real time, right in the public markets. We're watching one of the most volatile and strategically complex situations in finance today. A direct collision between a high-efficiency industrial roll-up strategy, Brad Jacobs' signature move, and the just chaotic dynamics of modern market microstructure.
And that collision, as we know all too well, has left some deep, undeniable scars. I mean, we see the stock today stabilizing around, $21.09, yeah. And that's propped up by the foundational $14.2 billion market cap from the Beacon Roofing Supply acquisition. But we just cannot forget that this stabilization only came after the summer 2025 repricing event, a truly catastrophic moment where $114 billion in, quote, paper market cap just evaporated.
Exactly. And that historical yet very recent volatility, it really defines our central question today. Given QXO's structural complexity and the severe technical weakness you can see on the charts, is this $21 price fundamentally a rational entry point? I mean, has the market finally stripped away that temporary, that artificial liquidity premium and positioned the stock as a long-term leverage bet on Jacobs' operational blueprint and, the ambitious $50 billion growth thesis?
See, I come at this from a completely different angle. I believe the fundamental valuation is still inflated. That 2025 crash is more than just a memory. It's baked into the technical structure of the float, into its cost basis, and when you factor in the persistent execution risks, inherent in such massive M&A, the ongoing technical damage you can see on every single time frame, and the structural overhang from the initial insider positioning, the current price just hasn't corrected enough to justify that kind of optimism. We're trading on hope, not fully digested reality.
Well, the bullish premise here is pretty straightforward, and it rests on something I think is very concrete: the Jacobs premium. This isn't just hype. It's an economic moat that's been proven by an algorithmic, repeatable success model across 5 previous multi-billion-dollar companies. We're talking giants like United Rentals and XPO. His strategy is almost mechanical. Find a fragmented, low-tech, low-multiple industry, and the building products distribution sector, an $800 billion market, fits perfectly. Acquire key players and then integrate them onto a unified tech platform to dramatically drive margins and scale.
That's a compelling track record, absolutely, and it's why so many were drawn to the stock in the first place. But we have to look beyond the track record to the plumbing of this company. I really challenge the assumption that this premium comes without a significant structural cost.
But let me just offer a little more context on commitment. Look at the significance of the December 2025 leadership restructuring. Jacobs resigned from his executive chairman roles at XPO and QXO, effective December 31st, just to dedicate his full bandwidth to deal-making and integration at QXO. That is the ultimate all-in signal. He has effectively eliminated the key man distraction risk that skeptical analysts were always citing. When he puts his entire focus onto an enterprise, the probability of success, it shifts dramatically.
I acknowledge the dedication, I do, but the company's genesis created permanent, structural problems that even his total commitment can't just erase. This wasn't a clean IPO. It was a Silver Sun reverse merger, a maneuver that grants immediate access to public currency, but structurally, it creates a massive supply overhang. We have to dwell on the cost basis discrepancy. The insiders, Jacobs Private Equity, and the co-investors injected $1 billion at a cost basis of approximately $9.14 per share post-split.
A crucial data point, sure, but one that reflects a private market valuation, before any liquidity.
It's more than just a data point. It's a psychological and technical drag. That cost basis is over 95% lower than the public trading peak of $290. When insiders have that kind of unrealized margin sitting on nearly 3 times their investment even after the crash, it creates a structural reality where any positive move can be met with institutional profit-taking. They know they can sell far below the public peak and still get massive returns.
But that profit-taking only becomes relevant if the public market is actually trading at prices relevant to the float. And that brings us right back to the crash. I maintain that the crash fundamentally supports my bullish thesis now. The event was purely market microstructure. It was not a destruction of any operational value.
We agree on the technical cause, yeah, but not on the ultimate implication of it.
The stock peaked at $290 because only 0.1% of the float was tradable due to strict lockup restrictions. This created an artificial scarcity, violating a core principle of finance, the law of one price. It meant the market was effectively valuing $1 of cash on the balance sheet at $26 because so few shares were available. The July 29, 2025 lockup expiration simply introduced liquidity, which removed that scarcity. The market didn't collapse. It efficiently repriced the equity back toward its asset base. It now trades rationally at roughly 1.3 times sales. The technical shock just removed the speculative excess, leaving a company priced on actual assets and the potential of its architect.
But that's a clever way to frame the correction, I'll give you that. But I would argue that while the cause was technical, the effect was profound. And the technical damage is not easily repaired simply by saying the law of one price was restored. The stock suffered a very clear death cross in late 2025. That is, when the 50-day moving average drops below the 200-day. For any technician, that confirms a shift from a price appreciation phase into a sustained distribution phase, where sellers are just dominant.
But the distribution phase is also where the smart money accumulates.
Perhaps, but the short-term reality is brutal. If you just look at the chart right now, the stock is trading below its 5, 10, 20, 50, and 100-day moving averages. Every single one of those averages acts as dynamic resistance, which means any attempt to move higher is immediately met with selling pressure from technical traders and algorithms that are programmed to sell into strength. The chart isn't just messy, it's structurally engineered for persistent bearishness until some major macro catalyst can break that trend.
I think focusing solely on the chart's historical damage really misses the active accumulation that's happening right now. I look at institutional conviction, which is strong. Wall Street analysts are overwhelmingly bullish, with price targets from $28 to $40 from respected firms like Loop Capital and William Blair. But the real story is in the trading mechanics. We need to look at the high off-exchange short volume ratio, which often hovers near 49 to 50%.
You're referencing the dark pool activity, which is, a contentious metric to rely on.
Exactly. High dark pool volume, particularly when the price is holding stable near support, suggests institutional accumulation is happening quietly. The smart money, these large funds that don't want to spike the price on the public exchanges, they're absorbing the float in these off-exchange venues. They're avoiding the attention of retail traders and preventing the stock price from rising rapidly while they build a position. This is a classic bullish divergence. Price is flat, but heavy, controlled volume is flowing in.
I'm just not convinced that hidden accumulation can overcome the visible resistance because of the immediate psychological ceiling on the public exchange. We have what analysts call the bag holder wall between 2127 and 2195.
Define that for us in practical terms.
The bag holder wall is a powerful psychological ceiling. It's the zone where retail investors who entered their positions at much higher prices, maybe chasing that 290 peak, are finally seeing the stock reach a point where they can exit without massive, career-threatening losses. So they sell, just for relief. This sustained, non-institutional selling creates a ceiling, preventing any real upward move above $22. The overall trend remains bearish because this overhang has to be slowly absorbed.
And how do you reconcile that ceiling with the vulnerability of the short position? The short interest, currently around 10.5% of the float, is moderate, but it's highly vulnerable. The days to cover ratio is between 8.6 and 15 days. That means if QXO announces another major acquisition or delivers an unexpectedly strong earnings report fueled by the Beacon integration, the subsequent demand from shorts covering their positions could trigger a violent, multi-day short squeeze, which would easily overpower that bag holder wall and invalidate all of your resistance levels.
That's all predicated on a perfect catalyst materializing and, frankly, ignoring the gravity of the potential downside. If the stock breaches that critical intermediate support level around 1991 to 2023, it would likely trigger a massive flush of stop-loss orders from automated trading systems. That level holds substantial volume support from recent institutional entries. If that fails, technical gravity takes over, reinforcing the downward trend regardless of whatever is happening in dark pools.
Okay, let's shift away from the chart for a moment and focus on the fundamental business that Brad Jacobs is actually building, because this is where the long-term thesis truly rests. The operational reality post-Beacon is a robust defensive foundation. Beacon roofing supply is heavily tilted toward re-roofing demand. 80% is driven by non-discretionary replacement cycles. This structural characteristic really insulates QXO's revenue stream from the volatility of new housing starts or, discretionary spending.
That defensiveness is a strength, I agree. But M&A discipline is just as important as the operational foundation.
And QXO has demonstrated that discipline. They publicly refused to overpay for GMS Inc. when Home Depot outbid them. This shows a commitment to not pursuing growth at all costs, a critical factor for any roll-up strategy. The Q3 2025 net sales of $2.73 billion prove the operational mandate is firmly underway.
But what about the cost of that mandate? We can't just talk about sales growth in a vacuum.
Management is targeting a very aggressive goal to at least double legacy Beacon EBITDA organically using the QXO operating system. This is where the Jacobs premium truly delivers. They use proprietary technology, AI logistics, centralized procurement, automated route optimization to extract synergies and increase margins across a historically low-tech distribution footprint. And on top of that, they're sitting on $2.3 billion in cash. That is significant dry powder for further non-dilutive tuck-in M&A, smaller, high-synergy deals that won't require massive public offerings, mitigating that dilution risk you correctly pointed out earlier.
I have to acknowledge the sophistication of the integration plans and the size of the cash hoard, but that integration requires immense capital and patience. QXO reported a GAAP net loss of $139 million in Q3 2025. That net loss is a direct indication of the substantial transaction, integration, and restructuring costs needed to digest the Beacon acquisition and build out that operating system. This is money that has to be spent before those promised EBITDA gains can materialize.
Integration costs are inherent in any large M&A transaction. They're a short-term hit for a long-term gain.
I challenge the premise that these are just short-term hits. Achieving the stated goal of $50 billion in revenue requires a massive 4 to 5 times increase in the size of the enterprise. This is fundamentally dependent on future M&A, which carries extreme execution risk. Each new acquisition just compounds the complexity, the debt load, and the integration hurdles. You're betting that Jacobs' team can manage increasing complexity indefinitely without a single major stumble.
Given his track record, yes, I am. He's done this multiple times before.
But even Jacobs is susceptible to macroeconomic forces. We are operating in a much higher interest rate environment than the one that facilitated the early growth of XPO and United Rentals. A prolonged recession or a higher for longer scenario for rates would substantially increase the cost of debt service on the $3.1 billion in existing debt and potentially dampen the high-margin renovation demand they rely on. If their cost of capital rises, the economics of future roll-ups they collapse. This squeeze on margins is a major risk that the current $21 price point, trading at 1.3 times sales, has not fully accounted for. The company needs to grow into its valuation, and that journey is highly capital-intensive and macro-sensitive.
The distinction at the end of the day comes down to what you choose to discount, the proven operational capability or the current technical mess. We've established that the investment thesis for QXO is a unique calculation requiring anyone listening to weigh an unparalleled track record against some significant self-inflicted structural hurdles.
And the conflict is exceptionally clear. On the one hand, you have the human capital argument, the undeniable success of Brad Jacobs, the operational blueprint, and the commitment signaled by his resignations. and institutional money, as evidenced by those high off-exchange short volume ratios. It seems to be rationally accumulating shares at this price point, viewing 2109 as a discounted entry into a compounding machine.
I agree. The current valuation appears rationalized, stripped of the speculative frenzy that drove the stock to 290. The Beacon acquisition provides a defensive, cash-generative platform, and management has demonstrated the discipline and possesses the dry powder needed to pursue its massive growth targets through targeted, non-dilutive M&A. This current price feels like the rationalized floor, not a ceiling.
However, the structural costs and technical baggage cannot just be dismissed. The massive dilution required to fund the initial Beacon deal, the fact that insiders maintain a cost basis over 95% lower than the public peak, combined with the persistent selling pressure you see in the chart's moving averages and the resistance at that bag holder wall, it all suggests that the stock is still in a technical distribution phase. The market may have removed the $114 billion speculative excess, but the stock has yet to fully bottom or successfully absorb the psychological weight and the integration costs required for future growth.
The material clearly provides credible support for two drastically different outcomes. The data shows a company with a proven mechanism for value creation, currently priced for moderate success, but burdened by a very volatile history.
So the choice for the listener, then, is really a matter of conviction. You have to weigh the powerful, proven track record of the architect against the messy chart and the persistent structural drag created by the financial plumbing of the trade. Both sides of the data are compelling, and only time will tell which force proves dominant.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.